Hi there, everyone, and welcome to this month's edition of OnTrack. It's the 30th of November as I record this in not so sunny Queensland, but we've had some great weather, and can you believe it's in a month we'll be past Christmas and preparing for New Year's Eve. What a year 2022 has been. So in today's episode, I've got all the performance for all the portfolios and the markets up to the end of October, all the news and charts and information right up to recording date. And it's been another interesting month in the world of markets and economies. I'm going to, as usual, put it all into context, share my thoughts around the share market, the property market, talk about what the news is focused on, and put it all in perspective. And I did almost skip that warning that I might have to make. This video is for clients of McGregor Wealth Management, and in particular those that use our care investment methodology and process. For anyone else, you're welcome to listen. I hope you get something out of it, but please seek advice before you act on anything we talk about in this. So I've got a quote for this month, another quote from John Templeton, one of the greatest investors of all time. But this quote I find fascinating at the moment. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So it's another way of talking about our wall of worry. And the pessimism here is the thing that's got me. Never have I, not for a long time have I felt a more pessimistic 6 months. I can feel some of it easing, and we've seen that in the share market results in the last 2 months. But yeah, and fair to say, this may or may not be the start of a bull market, but bull markets always start when they're least expected. So let's get into some of the news. And we've seen strong rebounds in the share markets. And that came about as we started to worry less about inflation, or as the market started to worry less about inflation because of data coming out of the States, and also commentary from the Federal Reserve saying that they can see some signs, and that may mean they have to be less aggressive than they'd initially made out. We've got contradictory talk as well. The Reserve Bank in Australia is still talking fairly tough, but the tough talk can do a lot of the work for them. Let's have a look at the numbers, the short-term numbers. The cash rate jumped another 0.25% to 2.85. 90-day bank bill rate is now about 3.11. Government bond yield has actually dropped back to 3.59. That's a promising sign on inflation. The Aussie dollar jumped, and I talked a lot about the Aussie dollar last month and the impact it has on international shares. The CPI, the numbers, keep in mind, this is the lagging indicator. That means it's reported well after the event. So the market is looking forward to leading indicators at the moment. So we're still seeing inflation print relatively high numbers at 7.3% was the latest. But some of the leading indicators are starting to show that prices are potentially, or the price increase, which is what inflation is potentially dropping. US inflation has actually dropped a little, 7.7%. Mortgage rates seem to have peaked, the lowest mortgage rate around that 4.29, Macquarie variable rate about 4.54. So most bank headline rates start with a 5, and any second tier lending starts with a 7. We're seeing Macquarie's term deposit rates just drop off slightly. You can get 4s. We're seeing plenty of 4s for 1 year, and we're seeing kind of what I'd call a normal situation. You're getting, if you chase hard, 2% for your cash, and then you start term deposits at about 3% for 3 months, up to 4% for a year. So reasonable returns on your cash. So if you've got cash sitting around that isn't suitable to be invested, make sure it's working for you. We saw the US midterm elections come at the start of November. It was expected to be a red wave, and in the US that means towards the Republicans, but we saw that not happen. So it was pretty strong for the Democrats. They didn't lose control of the House, which they thought they might. But the clear message was the Trump nominated candidates did very badly. So middle America is sort of saying, we've had enough of this guy. We're not interested. The Republican candidates, like the potential next US presidential nomination, Ron DeSantis, actually did quite well where they were not endorsed as chosen ones by Trump. So I'll talk about this a bit more, because it looks like we're seeing, that sensationalist side of politics just starting to repel people a little. Crypto, just the chart down the bottom there on the right, which this is the Bitcoin price. We've seen these massive waves. We had the big Bitcoin boom, 2017-18, followed by a collapse, followed by a recovery, followed by a massive further boom through 2020-21, was when everyone was asking us, should I be investing in Bitcoin? Bitcoin is one for the very, very educated speculators. And I know some people that have done well in Bitcoin because they've made it their profession almost, but it's been tragic for the average punter who tended to get in right at the top of the market. We're now seeing that down, nearly 85, 90% from its peaks. Who knows what happens to it? It's a speculative asset and one which we don't play in as investors. We're seeing some interesting stuff out of China in terms of some protests at the lockdowns. It's going to be fascinating to watch that. You don't see many signs of civil unrest in China. I think it's a healthy sign. It seems to me so far they've actually listened to them a little bit. Watch this space. We'll see how that progresses, and I'll talk more about that in my news cycle that I'm going to talk through again. The portfolios. So it was a good month. We see the high growth sector jump 5.83%. It's up another 5% in November already. So in 2 months, a recovery of 10%, which is really good to see, and a reward for the patience of you guys as investors. And markets back to what we consider about fair value. Longer term, you can see those 7-year, 5-year returns. They're within the ranges that we would expect and project and use for the plans that we make for you guys. They're not brilliant, but we're still in a ditch, and you can still see the 1-year rate is sitting at minus 4.6% on a high growth portfolio, minus 4% on a balanced portfolio. And that's an indication of the correction that we've had, which is the price we pay for good long-term returns. So my behavioral bias for this month is a repetition of one I did a few months ago, but it's highly relevant. That is recency bias. So recency bias is the tendency for us all to focus more on current events that are, and we give them more importance than they actually deserve. So it's the fact that any new information or new news, and the example of this is at the moment, the relentless focus on inflation in particular, and the fear of inflation, we're now making it probably way more important than it is to financial markets in the long run. Don't get me wrong, it's important, but we're making it more important than it actually is. I'll talk more about that from a few angles. Updated on our wall of worry chart. So this is the last 20 years, and this is the cycle, the model that we sort of use. The market goes through those 3 stages, from fear to FOMO, which happen very rarely. Most of the time, the market is in a wall of worry, where it climbs the wall of worry. We're forever worrying about things. And in this case, we know that we've had 6 downturns of more than 12% since the GFC back in 2008. And they've all been on the fear of something: fear of global economy worsening, fear of the Greek crisis, fear of fear of slow growth and falling oil prices, fear of tightening plus trade wars, and then fear of inflation. The Ukraine war led this off, but as we recovered from that, the fear of inflation became the dominant force. You can see that jump now of nearly 10% off the bottom. So we're fast getting back to where we were. Not quite. And this is what the market does in a wall of worry. We're always worried about everything, but the underlying profits of companies and performance of company keeps coming back. And that's because generally for most people, we're still spending the same amount of groceries. We've still got our mortgage, which is profits for the banks. We're still buying things, and I'll talk more about consumption shortly. So that means the economy keeps going, and that means companies keep making profits, and that means the share market rises over time. Now, occasionally we stop worrying and we get into a boom like we saw in 2004, 5, 6, 7. We haven't had a boom since then, one where markets go crazy and double within a 2 to 5 year period. They happen every 20 years or so. It's obviously 15 years or so since we've had one. I dare say we'll get one in the next decade, but that's just me using the law of averages. Doesn't mean we've got one starting now, but it could be. And when they go, you don't want to be missing those, but you do want to then be preparing for the inevitable fear on the other side when when it comes back out of it. And you'll see that straight line that goes through the middle, and that's the long-term direction of the reason we invest in share markets as a decent part of most portfolios. Let's have a look at 10-year government bond rates, and you've seen me show this, and this is the market showing the return you get for bonds on different levels. So the blue line is the current rate. So at the moment, you can see that 10-year bond rate has actually dropped back. The green dotted line is a month ago. So we're seeing 10-year long-term bond rates fall. They're still up from where they were 6 months ago. And in the bottom here, I've got the actual bond yields plotted going back over the last year. So we came from this incredibly low place of about 1.5% long-term government bond yields. That was a record low. So we've now emerged back into what could be considered a new normal, with a range of between 3 and 4% for government bonds. If inflation gets under control eventually, and it probably will, and gets into the Reserve Bank's target range of 2 to 3%, targeting about 2.5%, you would expect bonds to pay about 1% more than that, so 3.5%. Now, it'll fluctuate like it does here, but the key losses that came from bond markets happened from that big climb from 1.5% to 3% to 4%. The same in the States, and we're now seeing this settle down as people see signs of inflation diminishing. Now, once again, I'm going to repeat, if the long-term bond market, which is one of the biggest financial markets in the world, thought that we had a longer-term problem with inflation, you would see much higher bond yields, particularly at the long end. We're just not seeing that. So I want to touch on something I touched on about a year ago, and that's the news and the markets and a framework for understanding. So when we get some news, if you look at the scale here, I've got a 2x2, nice way of analyzing things. And when we get some news, it's either good news or bad news. And it might be very good news or very bad news. And it's either completely unexpected. Sorry, it's a big surprise, or it's completely expected. And I'll give you an example. When they announced that inflation was 7.3% last month, it was completely expected. The market expected it. So that it was, and it was neither good nor bad. So that news in the middle meant markets didn't change very much on that news, even though a headline could have been written, inflation up further. This works in a few ways. So if we get bad news and it's unexpected, that's not good for markets. So very bad news, it's a big surprise, like COVID, meant markets go down in a hurry, like the breakout of the Ukraine war, like the emergence of inflation when it's not expected. So if news is bad and unexpected, or if it's, and I'm going to use some bad grammar here, apologies, but it helps to explain, or if the news is more bad or worse than it was before, that causes markets to go down. And even if it's less good, if we've been expecting good news, and you see this often with company share announcements, they make a profit and the profit looks good, but it wasn't as good as the market was expecting. So the market price of that company goes down. People go, oh, how does this happen? They made a good profit. Why is the price gone bad? It's because the market builds in all the information that it knows about into prices. The same applies for good news. Unexpected good news, that's a surprise. So I'll give you a good example. At the moment, the market thinks this Ukraine-Russian war is going to drag out. If it stopped all of a sudden, that would be good news. That was a surprise. So markets would absolutely go up. And the same as if news gets better. So if we think inflation is slowing by a little, but all of a sudden some figures come out and it slows by a lot, that would be better news than we expected, and markets would go up. And the same is true, and this is the one that people have trouble comprehending sometimes, if the news is less bad. So, and this applies to wars. We start off thinking this is really bad, but then as it just settles in and we realize there's no major worse impact on the economy in some cases, and the news becomes less bad, we actually see markets go up. So this is what we've seen in the last 2 months. Think about this. Markets up 10% while people are still worried. And that's because some of the news has been less bad. We haven't really had any good news. And if you think about, I haven't talked about it for a few months, but COVID cases are still running rampant around the world. Inflation's still printing, but there's signs that that's diminishing. So the news less bad has meant markets go up. And important to remember, and this is built into the way we analyze markets, by definition, that wall of worry that is there most of the time. And when we look at that wall of worry, we see that we get these downturns based on fear, which is either bad news or worse news or less good news, followed by recovery as the news becomes good or is better or is less bad. And keep in mind that thing down the bottom, all current facts and opinions are built into the current market price. So every educated analyst in the world has their opinion reflected in the current market price. So to beat the market, you have to have a better or smarter opinion and act on that, which is very, very hard, which is why for most of the portfolio, we don't attempt to do that. We just structure the portfolio in a way that will ride through these inevitable ups and downs, which are inevitable. One of the things people are worried about is company profits. And this chart, which comes from one of our sources at Yardeni through our friends at Realm, shows company profit expectations. So this is the analysts that analyze all the companies out there. So it shows where they think profits are. And you'll see this tail off at the end of the year. So when they start forecasting 23, you often see it go up and it tails off. A lot of these tail off at the end of the year, with the exception of the COVID year, where we had a big dip and then a recovery. So analysts here are effectively saying, and the big thing here is they've been predicting, or the media and some people have been predicting, a big collapse in earnings per share for companies brought on by a recession. Now, that hasn't happened for a few reasons. One, we haven't had a recession. We've had a very minor slowdown in growth, which I talked about last month. But two, there's a war chest being built up where people saved a lot over the last few years, and I'll talk about more. So they're still spending some of that war chest, even as their income potentially goes down or stabilizes. So let's have a look now. I love this chart, and it's a little complicated first, but let me talk this through. So this also from our friends at Realm, and it talks about how anxiety is an excellent backward-looking indicator. That means anxiety is very good at predicting what's already happened. So this is smart people. This is analysts. So this is economists, anxiety index, or the anxious index. So it rates the probability of them thinking that we're going to have a decline in real GDP, which is a slowdown or a recession. So the blue line is what they think. The grey line is what actually happens. Now, if they were very good at their job, you'd see what happened in 1979. They would predict a recession and then it would happen. But that's the only one in the last 50 years that they've predicted before it happened. Everything else, they've predicted it after it happened, which is pretty useless. So all these blue bars happening at the end of the grey zone means after we've already had a recession and we're starting to come out of that, they're predicting the recession. So these are smart people. And if they can't predict what's going to happen in the next quarter, heaven forbid their predictions over a long period of time. And as I pointed out, take with a grain of salt any analyst predictions of short-term movements in economies and markets, because it's absolutely impossible to predict. Here's what no one's talking about, and I've called it the war chest. So it's the savings ratio. So these charts from Australia in the top left, US in the bottom left from our friends at Trading Economics shows the savings ratio. So this is the percentage of household income that we save. And Australians, saving along at around 5%, give or take a bit. Notice how we spent money in the good times. We spent our savings. So in the boom times of the early 2000s, when we felt comfortable, we actually had negative savings. We spent all the money, and that actually contributed to the boom growing. But look what happens when COVID hits. Our saving rate jumped from around 5% up above 20%, and it kept above 10% for the next couple of years. Now, what that means, if you picture someone earning 100,000 and all as the economy, and all of a sudden they're saving 20%, they're putting away 20,000, 15,000. So all of a sudden they've got a couple of 100,000 up their sleeve for when an inevitable slowdown occurs, and they can then spend that. So we're seeing that savings rate now drop back to normal. So that means as people are facing higher costs, whether it be from rising energy costs, petrol, gas prices, or interest rates, mortgages, there's a war chest there, which means they're dipping into those savings to keep spending. We see that with a lot of our clients, our retired clients that just didn't spend as much over the last few years because they couldn't travel in particular. They're now saying it, I'm going to spend, even though markets are down. They've got money that's built up because they haven't spent. They're happy to spend. And this is what is partly keeping us out of recession so far. Not to say we can't slow down, but that war chest means there's substantial funds on the sideline. Now, it's not necessarily uniform who's got that money. In other words, whether it's older people, younger people, richer people, poorer people, it's more likely to be older people that have got more money. But a lot of people we see were ahead on their mortgages. So that means they can soak up the higher payments for a few years. So yeah, interesting. And it's something that no one's talking about. So I've talked enough about our wall of worry. I won't go into that anymore for this month. And just pointing out the recovery we had from COVID there. So we make no attempt to predict short-term movements of 5 to 15% downwards. We're very interested in trying to be aware of the potential for a downturn of more than 20%. And every case we've had a downturn of more than 20%, except for COVID, the market has doubled in the previous 2 to 5 years. So at the moment, the Australian market has doubled over about a 10-year period. So we have a very low risk of a correction of more than 20%. There is always, and as I pointed out earlier, there's been 6 corrections of more than 12% since the GFC. So these things happen every 2 to 3 years. They're completely unpredictable, and trying to trade them or avoid them is absolutely impossible. And no one has ever made any money out of trying to predict and trade those short-term downturns. Our mess it up analysis means that most investors mess it up, as proven by the Dalbar study, which has been going for 30 years, which shows the returns that investors get, which is the bottom of these bars here, is way less than the returns that their investments get. So while the share market averaged 10.65% over that 30-year period, investors only averaged 7% because of their tendency to panic when markets are down and get excited when markets are up and buy the wrong things for all of these reasons. And I'll do a feature of that. But the biggest ones at the moment are the media's sensationalism, trying to make everything catastrophic, their short-term focus and their obsession with single issues like COVID for so long, now inflation, but also weather events we're seeing. And that distracts people from bigger picture principles, which is so important when it comes to investing. These are the principles we go by with our care investing. So it's, they all sit on the fundamental belief that all the best investment strategies are built as part of a plan. It's based on your goals and your circumstances. We are very nerdy about history. We need to understand history. It doesn't repeat, but it rhymes. We go through similar emotional stages of history, and that's why we spend so much time analysing that. And one of the reasons we do these monthly updates is to help you guys make sense of the news, and that helps you avoid bad decisions and make good decisions and not mess it up. And then we can let our investments do the work over the long run through the asset allocation, the diversification, and the rebalancing. All right, let's update on the individual asset classes. Aussie shares up 5.94% for the month. But if you look at this, they're up another 5% since then. So up 10% from the bottom of the market. Now at what we would consider fair value. It's going to be fascinating to see when they settle down here. I suspect on any news that inflation is still persisting, if it's bad news or less good news, we may see some more dips. But in the long run, as inflation comes out and the news becomes better, we'll probably see some growth as well. But we may see some sideways from here. Obviously, dividends on top of this as well. You'll see the patience that long-term investors get. When you look at the value of $10,000 invested 10 years ago and invested in the index or BAS, about at 27,000. Now, the average fund manager, only 23,000. So we see the massive value of index investing in the broader share market that gets way above average compared to professionally managed funds. That's why we use index for the majority of the portfolio. So yeah, great results for the patient despite the dips with COVID and the current dip, great long-term returns. US shares the same, actually higher over the long run, 53,000. But half of that, as I talked about last month, has been due to the decline in the Aussie dollar over the last 10 years, which has resulted in US shares giving us a return over the last 10 years of about 16%, when in the States, they've only delivered US investors a return of 10, 11%, so in the normal range. But we've had a free kick from the falling Aussie dollar, which is why we made some changes to the portfolio to protect some of those profits last month. And I'll give you an update on that over the next few months as we see how that plays out. So we believe the US market itself is back at fair value after declining, particularly in the tech sector over the last little while. That was small caps. Big caps, the market leaders like Apple, Microsoft, etc. Same sort of story, 15% over 10 years, which has seen $10,000 grow to 45,000 in the index, or in IOO, actually more than the index in this case. But we're seeing it a bit flatter, up 7.7% last month, but flat since. Part of that is because the Aussie dollar's gone up, and we actually switched from IOO to IHOO, which is actually up 5% for this month. So that'll flow through in the portfolio returns. And emerging markets, boy, have they had a tough time, down 19% for the year. We've seen a little bit of recovery at the moment. Emerging markets are very, very cheap at the moment. And you'll see the quality of the companies in some of these. Companies like Samsung, Taiwan Semiconductor, they make the computer chips, and others. We've got the Chinese company, Tencent and Alibaba, that are like the Google and the Amazon sort of in China. They've been under pressure just with stuff happening in China, but ultimately emerging markets do deliver superior long-term returns, and they've still done pretty well over the last 10 years. And then we've got gold, which we have in the portfolios as insurance, and gold has been remarkably quiet over this year. So it's also, to me, a potential indicator that the markets, the professional markets, not the media, not the economists, are actually not that worried about inflation. Generally, when we get fears of high inflation, gold goes through the roof, and we just haven't seen that. We saw the spikes in gold pre-COVID, and you can see that here in the blue line, where gold went up dramatically through 2020 and served its purpose, but it hasn't done much since then. And that means that the market for gold is assuming that the world's doing okay. Let's look at the property market and a similar cycle, the boom, bust, boring cycle that we see, long-term steady uptick, but it often comes in really short-term waves. We use the analogy of the property clock. Now, it's just an analogy. It's not a perfect way of judging markets. You can see at the moment, for instance, we've got rising interest rates, which causes properties to come down, which they have. And I'll talk more about that in a minute. But we've also got an undersupply of rental properties, and rising construction at the moment. So there's different factors at work at any one time, and there's different factors at work in every different property market as well. Here's a really interesting look from Core Data on what's happened to prices in the five capital cities. Apologies to Hobart, which has actually done better than these numbers. So if you look at the last month, we're down. In the month. So prices, we know they're down, and since the pandemic, despite the predictions of forecasters, which I've talked about, the prices were going to drop. Markets jumped. The Gold Coast up 43%, Sydney up 25%, Melbourne up 11%, due to mainly its lockdowns. Adelaide up 40%, Perth up 23%. So the average of the five capital cities up 22%. Since we've had the inflation surprise in the first quarter, and we started to get obsessed with inflation, and that resulted in the expectation that interest rates would go up, we've seen the property market pull back up to 10% in Sydney, 6 and 7%, Melbourne, Gold Coast. It hasn't gone down at all in Adelaide or Perth, because those markets are at a different stage in the cycle, which I'll talk about in a minute. And compared to the pandemic, we're still up. So, and I know on the Sunshine Coast, we're sort of still up 30 to 50% from pre-pandemic. Gold Coast up 34%, Sydney up 11%. And then you go down, if you look at the last 12 months, since the 2017 peak, which is 5 years ago, property prices still extremely healthy. And the last 12 months, we're seeing a downturn in the bigger cities, but not so much in regional and not so much in the smaller capital cities. Since 2012, so 10 years, not bad. Sydney, you've doubled your money. That's ignoring rent. And in other places, 60 to 70% returns. I think Tassie and Hobart's about 250%. So property still continued to deliver good returns despite that cycle of news and everything else. And we still think there's value in some markets for a few reasons. One of those is vacancy rates. Have a look at the vacancy rates. So on the right is the October 22 vacancy rates, all sub 1%, all the low ones are sub 1%, quite tight. Look at Perth, vacancy rate of 0.4%. That means hardly any rental properties are vacant. And generally, you'll see vacancy rates at more like 2%. And that just allows for the fact that as people leave, it takes 4 to 5 weeks to get a new tenant. I've got several rental properties. At the moment, we've changed tenants for a couple of those in the last few months, and we've had tenants booked to go in literally within a week of old tenants moving out. So it's a good time for investors from a vacancy point of view. It's also a good time for renters from a rental point of view. Look at the rent rises in the last 12 months. Sydney up 28%, Melbourne up 22%, Adelaide and Perth up 18%. Now, while some people say this is because interest rates have gone up, so landlords put their prices up, landlords can't put their prices up if there's not the right conditions. So on those low vacancy rates mean prices can drift up as they have. Not great news for renters, but good news for investors. So two strong signals that are keeping the property market very healthy at the moment: low vacancy rates and strong rental increases. So the average for the capital cities in the last 12 months is up 24%. Now, if you think about it, that's similar to what mortgage payments are up for people as well. So it's hurting us all one way or the other, except for those that own their properties outright, which is most of all of our independent retirees. So they haven't seen this cost of living go up, so they're happily spending as well. For everyone else, they've adjusted, or they're dipping into those savings that I talked about, or they're working a bit harder, might be doing a bit of overtime. One parent might go back and work an extra day or two. Aussies have a long-term track record of meeting their mortgage payments by doing whatever it takes. It's unlikely to change. Interest rates, not much movement. Fixed rates on the right-hand side, you can see here, have pretty much steadied after going up dramatically from their incredible once-in-a-lifetime lows. Never before have we seen rates so low. We've got clients that fixed rates at 1.9%, back at the bottom of the market here. And they're smiling at the moment, although they are worried, of course, about what rates are going to be when they come out of it. So the rates on the left-hand side here are the variable rate, and you'll see their relationship with the cash rate. As the cash rate's gone up, so too is the variable rate. And as I said, you can still get rates at 4.5%. So that's about you get rates at 4.5%. So on this scale, it's about 0.5% below what the headline rates are. So it's very, very important to shop around. Give us a yell if you need a hand with that. I believe at the moment everyone needs to refinance or renegotiate their rates almost every year. So keep reviewing that. 1% interest rate differential on a $500,000 loan is $5,000 a year. So it's worth fighting for. It's worth refinancing or renegotiating. We see this in the volume of lending at the moment. So the colors here: investor refinancing, investor lending, investor refinancing in the red, investor lending in the orange, which is down a little. The blue is refinancing of owner occupied, and owner financing on the top. You'll see the average new lending amounts have gone up. This is the right hand side here, have gone up from around about the 400s to mid 500s, which reflects the fact that people are borrowing a bit more. That was partly a response to lower interest rates, but as interest rates have gone up, that's actually creeping down a little bit at the moment. The orange and the green there, which is both owners and investors, are borrowing slightly less. That's partly a reflection that property prices have fallen about 10% in that period as well, but still high there. So some interesting data. The property clock, and this month comes from our friends at Performance Property. We use Performance Property, they're buyers agents. So we use them for clients that are looking to buy an investment property. They've got the best data that I've certainly seen. They're very good at locating property that suits a client's long-term plan that we have developed for the clients. So in particular, as I've talked about before, Perth is still decent value for buying, and they rate. You'll see how they rate. The dark blue AAA is quality, capital city and similar properties. We don't do much in what I would call the triple B or the triple C or the triple D places, but for those brave enough, places like Rocky and the North Queensland, it's showing buy signals at the moment. I prefer to avoid that for most investors unless they plan on living there in retirement, just because they're too volatile. We're very happily buying into Perth and to a lesser degree Adelaide and places like some bits of Brisbane at the moment. But very, as I've stressed before, very important in this type of market where we've got higher interest rates to do your numbers carefully and to be buying for the long term. This is also useful for those that have property with their considering selling, unless you're going to hold for another cycle. So for many of our clients, they've taken advantage of the higher property prices to cash out of their properties in places like the Sunshine Coast in Sydney at the high end of the market, knowing that they can then pay down debt as they prepare for retirement. So once again, personal advice necessary. So let me wrap up as always, and with those fundamental principles and belief that we believe all investing is best done as part of a real financial plan. And a real financial plan is one that actually has goals based on who and what's important to you. The portfolio is designed to meet those goals, and we take a long-term view. And that means we can get the right level of diversification, the right asset allocation, and enough liquidity to ride through the cycle. We use low-cost index for nearly all the growth markets, and we will vary from that only when there's a good reason. We protect against short-term volatility with reserves. That means having some conservative assets for our retired clients, which means they never have to sell good assets at a bad time. And we use dollar cost averaging for our clients that are growing their wealth. And that means they're buying on a monthly basis, which means the last year has been brilliant for them because they've been buying shares on special. And as we see shares return to their normal prices, all those shares they bought during the last so-called bad year have jumped 10%. So they're the protections against short-term volatility. We rebalance the portfolios regularly, which adds between 0.5% and 1% to returns over time. And we keep reminding ourselves and you guys, there's only 3 ways to lose money in the markets and not to do it. That is panicking and sell, that is having to sell, and that's not being properly diversified. When we make sure you don't do all of those things, you win and you reap the reward of those long-term gains that come through. Sometimes it's nervous, and I congratulate all of you guys for hanging tough through this. Our newer clients, those have come on board in the last year to 2 years, I know it's been tougher going through your first downturn, but we haven't had anyone panic. And yeah, hopefully you'll now see the rewards of that in the coming years, and particularly over the long run. Thank you as always. I'm going to sign off. I will talk to you once before Christmas, so I won't wish you a Merry Christmas yet. But have a great December and have a great month, and hopefully you out there enjoying life and not paying too much attention to the markets. Rob McGregor signing off.